Hello and welcome to Accounting with Mr. H. In this video, we're going to look at the basic principles of double entry, the different types of ledger account, and how we can use techniques such as DEAD CLIC or pearls to identify whether we need to debit or credit an account. Please do remember to subscribe to the channel, like, share, and comment on the videos. Let me know what you find useful and what you'd like to see in future videos. The two techniques then that we're going to be looking at in this video are DEAD CLIC and pearls, and these are really just acronyms, little aid memoirs to help you just identify which side of a T account, a ledger account, you need to enter an item. And DEAD CLIC and pearls, they're both similar. You can see on the left hand side how they work. So DEAD CLIC, the DEAD tells us that we debit expense accounts, asset accounts and drawings, and we credit liabilities, income and capital. And pearls is very similar. Pearls just emphasises more purchases and sales, as in we debit the purchases and we credit the sales account. But otherwise they're pretty much the same techniques. Before we can actually get stuck into looking at how DEAD CLIC and pearls work, we need to just make sure we're happy with what these different types of account are. So I'm just going to look at the DEAD CLIC ones. So the first one we've got is expenses. Expenses then are the amounts that are spent day to day on the running costs of a business. So essentially the things that they're just having to keep buying. You can see some examples in that table. So purchases, a business purchases stock and then it just has to keep buying more stock because presumably they're selling it. So it just becomes a day-to-day cost. Things like rent, rates, insurance, all those bills that they have to keep paying each month, they're just part of the day-to-day running costs. On the right-hand side, you can see some further examples: motor expenses, general expenses, wages. We also include things like an irrecoverable debt as an expense. So if a receivable isn't able to pay us and we decide to write that debt off, that's cost us money. So it's treated as an expense. And in the same way, if we allow one of our trade receivables some discount, then we treat discount allowed as an expense because it's cost us to allow that trade receivable to have that discount. Then we come on to assets, and simply put, assets are things owned by a business. They're things that a business has that is of value, that is helping them in some way to run their business, or if it's current assets, they're things that are either cash or will soon be converted into cash. Again, you can see some examples there. The ones on the left are non-current assets. So the typical things you find: the property, which could also be described as land or buildings, fixtures and fittings, equipment, motor vehicles. And on the right-hand side, you've got some typical current assets: inventory, trade receivables, bank and cash. If we're using the DEAD CLIC model, the last D in DEAD stands for drawings, and drawings are money, or it can be inventory, goods, that the owner has taken from the business for personal use. We're talking here about sole trader businesses who are able to remove goods or money from the business for themselves. It just needs to be recorded as a drawing. So you can have drawings in cash, maybe they take them using a cheque or through the bank. And then, as I say, they can also take some inventory, and we call that goods taken for own use. We have liabilities, so these are effectively the opposite of assets, and simply put, these are the things that are owed by a business. So on the left, you can see there, maybe we've got trade payables that we owe money to, a bank loan, a bank overdraft. So bank is an interesting one because if we've got money in the bank, then it would be recorded as an asset because we own that money, that's our money. But if we have a bank overdraft, if we have a negative bank balance, then that will be a liability because we now owe money to the bank. On the right-hand side there, you can see a couple of provision accounts: provision for depreciation and provision for doubtful debts. These accounts are both treated as liabilities because they reduce the value of an asset. So provision for depreciation is normally linked to maybe fixtures and fittings or equipment or motor vehicles. So the vehicles, for example, are assets. So when we start depreciating them, that provision we make has to be treated as a liability in order to reduce the asset. And in a similar way, a provision for doubtful debts reduces the asset which of trade receivables. Income. Income is effectively the opposite of expenses. So income are these are the amounts earned day to day, either from selling products or from providing services. So the main source of income for most businesses will be the sales, also known as revenue, and usually recorded in an income statement as revenue. But we can also have additional income, such as rent received, commission received. And on the right-hand side there's a couple of other examples. Discount received. So if one of our trade payables has given us some discount, or we've taken some discount, then we would record that as discount received, and we treat it as income, because effectively we didn't have to pay that bit of money, so we've still got the money. So in a roundabout way, we can treat it as a bit of extra income. An irrecoverable debt recovered. If, having written off a debt, a trade receivable then pays us, well, then that's just a bit of extra, often unexpected income. So again, recorded as income. And then finally, in the DEAD CLIC model, we have capital. And capital, this is effectively the opposite of drawings. So this is when the owner is investing money, or it could even be some assets, into the business. And usual ways of doing it are capital, maybe some cash capital, or more likely, the owner would invest some money through the banking system, perhaps via a cheque, into the business. But as I say, it can also be the owner might give a motor van to the business. So it is possible to invest capital in the form of an asset as well. Pearls, if we just have a quick look at the pearls, you can see expenses, assets, revenue, liabilities, sales, similar structures. But in essence, that is the same sort of idea, same sort of model. Okay, let's have a look at a few examples then of how it actually works in practice and how we can apply these. I'm going to focus on using DEAD CLIC as a model, but if you're more familiar with Pearls, you should be able to relate to Pearls using this as well. So the example we've got on the right-hand side says we paid £500 rent in cash. So if I needed to double enter this would involve the cash account and the rent account. And you can see I've got the two T accounts, the two ledger accounts drawn ready. And the idea of DEAD CLIC or Pearls is it tells you which side to put something on in order to increase the value, the amount in that account. So DEAD CLIC tells us if you want to increase an expense account, an asset account, or drawings, then you record it on the debit. So by that logic, if you want to reduce an expense account, an asset account, or a drawings account, you record it on the credit. And DEAD CLIC also tells us if it's a liability account, an income account, or capital, to increase those three accounts, you record it on the credit. And then likewise, by logic, if you want to reduce a liability, an income, or a capital, you would need to record it on the debit. So let's go back to this example then. We paid £500 rent in cash. So the best way to do this is to firstly identify the types of account and then use DEAD CLIC to work out which side of each account has which effect. So cash is an asset, and DEAD CLIC tells us then we debit an asset account in order to increase it. Remember, DEAD CLIC tells us what to do to increase the value in an account. So in DEAD, we've got debit assets. So if I put something on the debit of the cash account, it will increase the amount of cash that we have. And then by logic, if I put it on the credit, it will reduce the amount. And you can see I've put some arrows there to remind myself. A rent account is an expense account. And DEAD CLIC tells us, same idea, to increase an expense account, we put it on the debit. So likewise, then to reduce an expense account, we must put it on the credit. So £500 rent in cash was paid. So we've spent cash. So that means we are reducing the asset of cash. So I'm going to need to record that then on the credit side. And then the rent account, at the moment, my T account is empty for rent. Well, I now need to increase the amount of rent we've paid. We need to show that we have paid £500 rent. So to increase the value of this expense account, I need to record it on the debit. And the narratives, remember, are just the name of the opposite account. So in the cash account, I've recorded rent, and then in the rent account, I've recorded cash. Let's have a look at another one. We sold £200 goods on credit to Aid plc. So I have my sales account and my Aid plc account already. Again, have a think what the types are. So sales is an income account. DEAD CLIC tells us to credit an income account if we want to increase the value of that account. So therefore we would debit it to reduce the value of that account. And Aid plc, so if we are selling things on credit to Aid, Aid will become a trade receivable. Trade receivables are assets, so this is going to be an asset account. And DEAD tells us to increase an asset account, we record it on the debit. So therefore, to reduce an asset account, we record it on the credit. And if I just think what's happened then, so we have sold some goods, so that's more sales that we've had. So I need to increase the amount of sales that we're recording. So in my sales account, using my arrows, using the logic, I need to record that on the credit then because there's been an increase in sales. But equally, we're now increasing the trade receivable. We now have Aid who owes us money. So we've increased that asset. So that's going to have to be recorded on the debit of Aid. And similar with the narratives, I've got Aid plc in sales and I've got sales in Aid plc. Here's another one. We bought a motor van for £10,000 by cheque. There are my two accounts, motor van and bank. Again, go through the steps. As you get more confident, you shouldn't necessarily need to write down what type of accounts they are. You'll just be able to use this thought process in your mind. So a motor van is an asset, and DEAD tells us to increase an asset, we record it on the debit. Therefore, to reduce the value of an asset, we record it on the credit. And bank is also an asset. So to increase an asset, DEAD tells us put it on the debit. So therefore, to reduce an asset, put it on the credit. So we bought a motor van. So we now have a van. So in my motor van account, we need to increase then that asset. We now own this van. So there it is coming on the debit. But we've spent money. So that's going to reduce the asset of bank. So on the credit side of the bank, I need to reduce then the amount that we have in the bank. And there we go. Another one, we put £15,000 by cheque into the business. So I've got the bank account involved and now I've got the capital account because this is us, the owner, investing money into the business. So bank is an asset account. So DEAD, we debit assets to increase the value and credit to reduce. And the capital account, DEAD CLIC, so the click side tells us to increase the value of a capital account, we record it on the credit, and to reduce the amount of capital, therefore, we would put it on the debit. This is where DEAD CLIC and pearls are just slightly different because obviously we have a separate entry for capital in DEAD CLIC, whereas we don't in pearls. I have also seen that pearls sometimes people have the R as reserves, or they have the sales, the S, instead of for sales, they have it as sources of funds. So that could be things like capital. So 15,000 by cheque going into the business. So this is increasing the asset of bank. So I need to put it on the debit then. And it's also increasing the amount of capital that the owner has put in. So I need to record that on the credit. And there we go with the two opposing narratives, capital in the bank and bank in the capital. This one then, we bought £600 goods on credit from So Limited. So this time there's been a purchase. So I think this is the second one we've seen where there hasn't been any actual transfer of any money. So it's not going to involve the cash or the bank account. So if we've bought goods, then that's purchases, but we've bought them on credit from So Limited. So we've now got a trade payable. So I've got my purchases account and my So Limited account. Purchases go through the steps. So what type of account? These are an expense. So debit, expenses to increase them. So therefore credit to reduce. And So Limited, if they're a trade payable, that means we now owe them money. So they are a liability. And CLIC tells us to credit a liability account to increase the value and therefore debit to reduce. So we bought these goods, so that has increased the purchases, so I need to record that on the debit. But we now owe So money, so that has increased the liability of So Limited, so I need to record that on the credit. Next one, we took £100 cash for personal use. So we've got the cash account, and if it's money we took for our own personal use, that's going to be recorded as drawings. So cash is an asset. We debit assets to increase the value and credit to reduce. Drawings, if I look at DEAD CLIC, so it tells us also debit drawings to increase the amount of drawings we've taken and credit to reduce. So we took £100 cash, so that has reduced the asset of cash, so that needs to go on the credit side. But we now have got more drawings. At the moment, the drawings account is empty, so I need to record the fact that we've now started taking some drawings, and so we need to increase the value of the drawings, so it's got to be recorded on the debit. Okay, just 3 or 4 more then examples. So we paid Joe a trade payable £600 by cheque. So bank, we use an asset account. So debit to increase an asset, credit to reduce an asset. Joe is a trade payable. That makes Joe a liability. And according to CLIC in DEAD CLIC, we credit liabilities to increase and therefore debit to reduce. So we paid by cheque, so that will have reduced the amount in the bank, the asset that is bank, so therefore it needs to go on the credit of bank. But it's also reduced the liability of Joe because we've now paid Joe this money, so we don't owe Joe as much money. Maybe we don't owe her any money. So it's reduced the liability that is Joe. So I need to record that then on the debit of Joe. Joe as the narrative in the bank account and bank as the narrative in the Joe account. Next one, what we've got here, we wrote off a £200 debt owed by Betty Limited. So Betty Limited must have been a trade receivable. They must have owed us money. So trade receivables are an asset. And we know from DEAD CLIC, debit an asset to increase the value, credit to reduce. And near recoverable debt, we mentioned this near the start. We treat that as an expense account because we've basically lost that money now. We're not going to get that £200 from Betty Limited. So an irrecoverable debt is an expense account, and DEAD tells us debit to increase an expense account and credit to reduce. So we wrote off the £200 debt owed by Betty. So Betty no longer owes us this money. So in the Betty Limited account, I need to reduce then because we're saying we're not going to get that money. We've written it off. So that's got to go onto the credit side to reduce the amount that Betty owes us. And then in the irrecoverable debt account, we need to increase this account because we need to record the fact that we now have had to do an irrecoverable debt. So that will go on the debit side. And the narratives, as always, are just the names of the opposite account. This one, we received £900 rent by cheque. So rent received is an income, and CLIC tells us to credit an income account to increase the value and debit therefore to reduce. And then the came by cheque, so the bank account, bank is an asset, debit assets to increase, credit to reduce. So we received this rent. So in terms of income, this in the income account, the rent received account. We need to record this on the credit because it's increased our income, but it's also increased the amount we have in the bank. So in the asset account, the bank account, I'm going to record that on the debit. And there it is, rent received 900. And we have here, we took £200 goods for own use. So this time the owner has taken some goods, some stock, inventory for their own personal use, and that needs to be recorded as a drawing. And when we take goods for own use, it also reduces the purchases. So you'll see there I've done my purchases account ready. So drawings, we know from DEAD CLIC, we debit the drawings account to increase and therefore credit to reduce. And the purchases account, purchases are an expense, and DEAD tells us we debit expenses to increase and therefore credit to reduce. So if we took £200 goods, That is a drawing. That's increased the amount of drawings we've done. So that needs to be recorded on the debit of the drawings account. There it is. But it has reduced the purchases because although these goods were purchased sort of through via the business, the owner has then taken them. So in essence, they're not a purchase as such of the business. We don't want to include them as a cost of the business because the owner has taken them for themselves. So we are going to credit the purchases account to reduce the value of the purchases. Key thing to remember then, whether you are using DEAD CLIC or PEARLS, is that those acronyms, those techniques, tell you what to do to increase the value of an account. So DEAD CLIC, you debit an account to, if it's an expense asset or drawing, to increase the value. And then you can work out the opposite. So to reduce the value of an expense asset drawing account, you will need to credit. And the same for all the other things on the credit side of DEAD CLIC. And it's the same logic if you are using PEARLS. Okay, I hope you found that video helpful. Please do remember to subscribe, like, share, and comment on the videos. Let me know what you're finding useful and what you'd like to see in future videos.